All right, today we're diving into Hathway. Now, this isn't just a story about an old cable company. It's about how that company has become the crucial digital pipes for one of the biggest corporate strategies in India today, a key part of the Reliance ecosystem. Let's break it down.
Okay, so the whole story here, the entire investment case, really boils down to this one big idea you see on the screen, the pivot. Hathway is making a fundamental shift away from its legacy traditional cable TV business and moving toward becoming the high-speed fiber backbone for Reliance's massive JioHome ecosystem. It's a huge change.
So let's start with the bull case. What's the argument for optimism here? Well, it really comes down to three core pillars: its incredible financial strength, its unique physical assets, and a massive potential catalyst that everyone is watching very closely.
First up, you have to look at the balance sheet. I mean, it's basically a cash fortress. We're talking about a debt-free company with such substantial cash reserves that they create a very strong, natural floor for its valuation. That gives you a powerful layer of protection. But it's not just about the money on the books. Look at their physical assets. Hathway basically functions like a utility company. It controls this massive, extensive network of what we call last-mile ducts. In an economy like India's, which is just incredibly data-hungry, that physical connection into millions of homes is an almost irreplaceable asset. Now, here's the real kicker for the bulls, the thing that could really move the needle. It's the potential for what the market calls restructuring alpha. This is the idea that a potential vertical merger with Jio could finally happen, streamlining all of Reliance's distribution assets, and, most importantly, unlocking significant value for Hathaway's minority shareholders.
And this potential upside gets even bigger when you consider the massive upselling opportunity they have. Hathway is sitting on over 10 million cable households that it could, in theory, convert to higher value bundles, combining broadband with OTT streaming services. This could dramatically boost their average revenue per user, or ARPU.
All right, so that's the optimistic view. But now we have to look at the other side of the coin, because the bear case here presents some really powerful and kind of complex counterpoints that you just can't ignore. Well, the biggest headwind is pretty straightforward. Their old school business is fading, and fast. I mean, this downward trend tells the whole story. The traditional linear cable TV model is in rapid decline. Cord cutting is cannibalizing revenue, and at the same time, regulatory pricing wars are just squeezing the margins. And this right here gets to the absolute core of the paradox facing Hathway. Believe it or not, it's now competing directly with its own parent company. Reliance is pushing its 5G wireless service, Jio AirFiber, super aggressively, which creates this bizarre internal rivalry that could sideline Hathway's wired fiber ambitions. So, what's the game plan? How is management responding to this internal competition? Well, they're pivoting again, this time to what they call the value segment. They're focusing on Tier 2 and Tier 3 cities. Basically markets where stable, reliable wired fiber still has an edge over the early and sometimes spotty stages of 5G wireless. And all of this leads to a historical problem that has frankly frustrated investors for years. It's what we call the conglomerate discount. For a long time now, Hathway has acted like a classic value trap. That's a situation where a company has these great, strong fundamentals and a cash-rich balance sheet, but it just doesn't translate into any stock price appreciation. Okay, so you've got this strong bull case and this really compelling bear case. How in the world do you square the two? Well, the verdict isn't a simple buy or sell. It's way more nuanced than that. This really classifies Hathway as a unique, kind of special situation in the market. And that brings us to what's really the central growth paradox of this whole story. On one hand, you have these incredible, rock-solid financials. That's a green light. But on the other hand, you have this persistently weak stock performance, a red light. What this means is that Hathway isn't really a standalone growth story right now. It's more of a tactical component, a piece on a much larger chessboard, just waiting for its parent company to make the next move.
So when you put it all together, the formal verdict from the source material is this. Hathway is a value trap, yes, but it's one with potential cyclical upside. This makes it a classic special situation play. The risk here isn't in the day-to-day volatility. It's in whether that big corporate event, that merger, ever actually happens. It's a bet on restructuring. So what's the bottom line? Well, the key takeaway is that there's no single right answer. The investment thesis depends completely on what kind of investor you are. You can see three clear paths. It's a buy if you're playing the merger angle, a hold if you value the safety of its balance sheet, or an avoid if what you're really looking for is a clear, independent growth story. And that really leaves us with one final and kind of provocative question to think about. For an asset like this, where its fate is so tied to a larger entity, what actually matters more to you as an investor? A fortress balance sheet that provides a safety net, or a clear independent growth story of its own? That's the core dilemma here.